Hi there, welcome to Kneppy Invest. Time for my weekly portfolio and technical update. We'll have a look at the performance of three of my portfolios. Yes, I have three portfolios following different strategies. I don't see why that would be a deal for or issue for anyone out there, but I can just imagine an expert, a professional telling me you should only have one portfolio, even though a lot of fund managers have multiple portfolios. So we'll have a look at the performance of my three portfolios, again, following different strategies. And then we'll delve into technicals. Technical updates, looking at the markets, commodities, bonds. And then we might, depending how it goes, have a look at some individual companies' charts. Now on to my portfolio update. So I have three portfolios, long-term, medium-term, short-term, or using slightly or massively different strategies. For instance, the long-term portfolio is the traditional, or using the traditional strategy that we are all taught to use: buy and hold high quality companies. That is how I started investing well over 10 years ago, trying to buy high quality companies. However, back then when I started investing, I had no idea how to analyze companies, how to find high quality companies, or distinguish between high quality and low quality. My first two companies I bought were Commonwealth Bank and BHP, simply because they were the two biggest companies on the ASX. But bigger does not necessarily mean better. And I wish some experts would understand that. I have heard from a few professionals these exact words: well, this is a bigger company, therefore I think this is a buy over this smaller company. Bigger does not necessarily mean better. And I have learned that lesson over the past 12 to 13 years. So now I try to find high quality companies using my own definition, and that definition evolves over time. Now, I want this portfolio to beat the market returns, because if I can't beat the market returns, I might as well just put my money into ETFs. And to be honest with you, I don't want to do that. I don't like ETFs, simply because when you buy an ETF, you're buying companies you probably would never invest in if there were no ETFs. That's the way I look at it. So anyway, long-term portfolio, which has numerous high-quality companies in it that I consider high-quality companies, has a total return since the start of the financial year of 1.67%, beating the benchmark, which is the STW, or an ASX 200 fund, which also has dividends. So the reason I use that as a benchmark is because it does have dividends, and you need to include dividends when you're looking at total return. That's absolute necessity. So at this point in time, long-term portfolio up 1.67%, beating the benchmark, which is actually down 1.01%. In fact, the benchmark, the STW capital gain, is actually down 3%. Some nice dividends coming in, 2% dividends. Best performing companies in this portfolio are Nick Scali, Pro Medicus, Breville, PWR Holdings, and Domino's Pizza. That's the Australian companies I own. Well, may not be Australian companies, but these are companies listed on the ASX. And in fact, the best performing company in my portfolio, third best performing company in my portfolio is Adobe. A little bit surprised. Now, this is since the start of the financial year. So even though I'm saying these are the best performing companies in my portfolio, overall, these are not the best performing companies in my portfolio at all. I have quite a few baggers in here, 3 or 4 baggers. So that's why I'm not concerned some of these companies' share price is down since the start of the financial year, because overall, they've done fairly well. Now, you might criticize me for some companies within this list. For instance, Telix Pharmaceuticals. Maybe that should belong in my medium-term portfolio, because I don't think you could necessarily argue that is a high-quality company just yet. So there are some questions about whether some of these companies belong to be in this portfolio. I sort of understand that, and I'm willing to actually move some of these companies out if I don't consider them to be high quality anymore. Anyway, so using this strategy should be successful over the long term if you have the ability to find high quality companies. And maybe that is a question for a lot of investors, is how you find high quality companies. And I do think I am on the right path in that regard. Now onto my second portfolio, which is the medium term portfolio. And These are not necessarily high quality companies. In fact, if I look, most companies within this portfolio, they are not high quality companies. They have potential to, and some of these companies I don't think have the potential to, but I find there is really good value because the majority of companies in this particular portfolio are small cap companies. I actually do prefer to invest in small cap companies because I do think the potential for future returns is better than larger companies. So I do have a preference in investing in smaller companies. And if you can find that small company that hits it big, that becomes a high quality company in the future, your returns are going to be sensational. Now, at this point in time, this portfolio is outperforming, significantly outperforming not only the long-term portfolio, but also the benchmark, a total return of 5.73% compared to the benchmark, which is down 1.01. Possibly I should, what if I could do it now? I'm trying to remember how you edit the benchmark. Possibly I should be comparing this to some sort of small cap ETF, which I have no idea what is a small cap ETF. Even if I do XSO, so let's change it to the XSO, which is a small cap indice. I'm significantly outperforming the small cap indice. So the problem with that is that has no dividends, but look at the capital gain. My medium-term portfolio is up 4.6% compared to the small cap XSO, which is down 4.33%. Now, what this suggests to me is that I can or have the ability to find the better small cap companies on the ASX. And I think that is definitely true. That's the way I look at it. I want to be positive, and I am doing this right. That's what I'm thinking right now. I'm doing it right. This portfolio, I'm on the right step, on the right path, probably the best way to put it. Anyway, do I really want to compare this portfolio to the XSO? Yeah, let's do it. Because it's better to compare like for like, I suppose, apples to apples. And because most of the companies, if not all the companies in this portfolio are small cap companies, maybe I should compare it to the small ords. So let's do that from now on. Best performing companies in this portfolio. Findy, up 100%. I think I have talked about Findy a couple of times. And the main reason I'm invested in Findy is just pure luck, because I had invested in a company a few years ago, actually quite a few years ago, and it's gone through a couple of name changes, gone through a couple of different strategies, and possibly it's hitting it big right now, up 106.4%. Email payments, up almost 100% since the start of financial year. And I have been trading that. Am I still trading that? I can't remember. I think I am trading that at the moment. Energy One, I bought back into Energy One because the takeover bid for that company has fallen through, up 88.51%. And Atlas Pearls, up 62.5%, even though share price down a little bit. Other companies here, Doug, Ansarada, Ordinate, Chryso Corporation, EZZ Life Science, Playside Studios, which is not a profitable company. And one of the things I'm going to change about companies I do own in the future, I will heavily sway the companies I own to profitable, free cash flow positive companies, and Playside Studios is not one of those. Doesn't mean necessarily I will sell out of that company, because if you have a look at the best performing companies within this portfolio, most of these companies are profitable. Maybe Ansarada is the only one here, Playside Studios, but most of these companies are profitable. But then if you have a go down the list of the worst performing companies, Pointera, well, Rectify is profitable, but it's undergoing some problems now. Victoria Health is profitable, but there is questions about the growth of that company. Vection Technologies is definitely not profitable, burning through heaps of cash. SciDev has been teetering on becoming profitable. SmartPay's there too. Cetar. Actually, quite a few of these companies are profitable. Frontier Digital isn't. Anyway, so very happy with the, and you'll notice the amount of companies I own in this portfolio. The other thing you can do is show only open positions, but doesn't actually make not much of an impact because I haven't sold many companies. So you notice how many companies I own in this portfolio. So I've been told a few times by viewers of this channel that I should only own 25 to 30 companies, because once you own more than 25 to 30 companies, you're over diversified. But that's silly, because that's assuming you're only buying the biggest companies on the market. So if you're only buying, or within the ASX, say 50, or maybe even 100, yeah, maybe you should only own 25 to 30 companies. And I can guarantee you, those who criticize me for owning too many companies more than likely own all the 4 banks in their portfolio, more than likely own Woolworths and Telstra. And to me, sort of companies are not the sort of companies I want to own for the long term because they're not growth companies. I'm looking for growth companies. I want capital gain and increasing dividends over the long term. So anyway, very happy with the performance of this portfolio, particularly when it's compared to the small ordinaries. If you go back here, the small ords was actually beating me for a little bit in July. Anyway, that was short term. Now onto my short-term portfolio, and this is using technical analysis, something I've been learning. The learning process is ongoing. I wouldn't necessarily call myself an expert on technical analysis, and I have made plenty of mistakes. Even though I have made plenty of mistakes, this portfolio has been doing sensationally, up 9.5% compared to the benchmark, negative 1.01. Now, what you see in this portfolio, what you should see in this portfolio is good returns. And when you look at the red, and this is something I'm going to do from now on, I don't want any company to have a negative 10%. I will sell out of those companies. So I've already got a few companies here that I should not be owning in this portfolio. ResMed, Vista Group, Integrated Research, I should have sold out them. And Vista Group was a mistake I made because of the low liquidity. That was a silly mistake I made. Integrated Research was another silly mistake. I should have sold that on the day the share price dropped heaps. But right now, the best performing company in this portfolio is Step One, up 67.8%. And I want to ride my winners. Now, ideally, I want to sell out at a profit, say between 20 and 30%. In actual fact, I have not sold any company for a profit between 20 and 30%. Because the next two best performing companies, Bravura, which I bought back in, by the way, I bought back in because the chart looks pretty good, and Nuix, both of those companies gave me a return above 30%, or between 30 and 40%. And then other companies that I own now up nicely. Yeah, I am trading email payments. ServiceStream, doing okay. Dicker Data, company I've recently bought. That chart looks absolutely spectacular, and I'm hoping I can hold that company for a while. I've also sold out of Wagner's. So two companies here I've sold out of, Wagner's, and I've also taken profits on Megaport. So I probably should update this. But even though I haven't updated, it won't change my profit all that much. Did I buy anything? I can't remember. Oh, yeah, Bravura. Yeah, so I have bought back into Bravura, and I should update that as well. So I'm very happy with how this portfolio is performing. And even though I'm happy, or I should be happy, I'm really focused on the mistakes I'm making. And if I can clean up the mistakes, have focused rules that I can follow, I think this strategy will perform spectacularly compared to not only the benchmark, no matter what benchmark I'm using, but also my other two portfolios. Okay, so that's all I got for the performance of my portfolios. If you have any questions about the performance of these portfolios or the makeup of my portfolios, anything, just leave your questions in the comment section of this video. So what I'm going to do now is something I've never done before. So I am going to put an ad right here. So instead of maybe forwarding through the ad, let it play out. Go get a cup of coffee, some tea, if that's what your favorite, or maybe some Pepsi Max, which is my favorite drink, and just let the ad run. And then come back, and then I'll start on the technical update portion of this video. Now to the technical update, looking at charts, just charts. Learning about technical analysis. I'm always learning about technical analysis because when I started investing, it was all about fundamentals. Didn't really care about charts. And one of my strengths, in my opinion, is my curiosity and open-mindedness. And I've got to acknowledge, I think everyone has to acknowledge their strengths and also their weaknesses. One of my biggest weaknesses is impatience. And I have seen it play out time and time again over the past 12, 13 years since I started investing. If I was a little bit more patient, I probably would be doing better than I have been doing now. So that is one thing I am learning, is for patience. However, in saying that, sometimes patience would have harmed me because I probably would have maintained a holding in a company that went down and down and down and down. Anyway, on to the XJO. And actually just going sideways. This is the daily chart. Yeah, there's nothing much to talk about XSO. If you look at the short term, nice bounce over the past 2 weeks, but last week, between the 6th and the 10th of November, The XSO or XJO was flat, which means the bears and the bulls are equal. No one's winning the fight between the bears and the bulls. So I've already touched upon the XJO in my week that was video. Let's have a look at the XSO, which is small caps, and this should be under more pressure. We already know that small caps are under more pressure, and this definitely looks a little bit more bearish than the XJO, but a nice run in the XJO over the past 2 weeks, up from 2560 to a high of 2700. A couple of days of falls in the XSO. However, the Nasdaq was up big, which I'll get to in a second, on Friday trading. So I do expect a good day, particularly for tech companies on the ASX. So for instance, Megaport, which I sold out and took profits. Maybe that was a mistake, maybe not. Anyway, can it be a mistake taking profits? I think it was like 16, 17% profit. Could it be a mistake? It could be a mistake. Instead of letting it run, being more patient, maybe. Anyway, don't dwell on those sort of mistakes too much. Learn from it, but don't dwell. And the Russell 2000, which I've shown before in videos, is the smallest 2,000 companies in the Russell 3000. So this is generally a small cap indice, and this is under pressure too. But a nice bounce off a good support level at around about 1,660. But the last 3 or 4 trading days, it is down 3 of those. In fact, 4. Down 4 and up on the last trading day of the week. And the reason it was up is because more than likely it was helped by NASDAQ. So let's have a look at the NASDAQ. And the NASDAQ was in a downtrend, which is portrayed by the sloping downward line. And we saw the NASDAQ hit that downward line about 3 times after the start of it. And then it hit it again on the Friday, the 3rd of November, so just over a week ago, and pulled above it. So there is a possibility. There is an end to the downtrend in the NASDAQ. So very fleeting time. The downtrend was very fleeting. I've been told, I should not in this video per se, but I've been told don't use very. There's better words to use than very. So very fleeting could be, what's a good synonym for very fleeting? Because fleeting is really fleeting. Maybe I should have just said fleeting. So the downtrend in the NASDAQ was fleeting. I've also told don't use was. The downtrend in the NASDAQ was fleeting. Hell, I don't know. Anyway, Dow Jones, which is not many companies. Was it 30 companies on the Dow Jones? This is sort of going sideways as well. No trend at all. Fairly similar to the XJO. So let's not really dwell on the XJO. Now onto commodities. And my favorite commodity right now, apart from uranium, and unfortunately I've sold my uranium stocks, just taking profits, is probably iron. Let's say lithium ion. Lithium ion is not a thing. Iron ore. This looks pretty nice at the moment. What's happening? I have no idea why iron ore is going up. I own one iron ore company, that's Mount Gibson. I sold out of Phoenix. I maybe should have bought Phoenix. Let's have a look at Phoenix, because I keep looking at Phoenix and it doesn't really rise, even though iron ore prices are rising. Yeah, it's still down. Maybe I should buy Phoenix at these prices. Anyway, so iron ore looks pretty nice right now. And if it can get above $130, getting above the highs we saw back in January and March of this year, that would be a bullish move. But a nice uptrend developing in iron ore. Can't say the same thing about gold. No uptrend for gold. In fact, it has turned down over the past 2 weeks. And you might even argue that gold is going sideways right now as well. I own a few gold exploring companies. And one of my rules is not to hold any exploring companies or mining exploring companies. I don't want to own many story stocks. And when I say many, I'm going to limit story stocks to 2 in my portfolio. Yes, mining exploring companies are story stocks, completely story stocks. Now onto uranium. I have to look at the weekly chart for this. This is a beautiful chart. It's been beautiful for a while. We're talking about start of 2020. It's been an uptrend, and sentiment in this particular commodity has changed, and it's still going up. So maybe there's possible some buying opportunity. I would prefer a little bit of a dip like we have seen back in May. So a dip down to say 68 or 58 to $60 would be good. Buy the dip opportunity. But anyway, congratulations to those who have held on to the uranium stocks. I sold out at a profit again, lack of patience, possibly. Oil down. So let's go back to the daily chart. Oil down. It's been going down for a while now, down from $94 a barrel down to 76. And no wonder oil prices or petrol prices aren't rising, although there is a cycle there, and I think we're at the bottom of the cycle, so I should be buying some more petrol soon. Anyway, so petrol, oil is down, and I was bullish on oil probably in September because the chart started to look pretty good. But sometimes trends don't last long, and this is definitely a situation where a trend didn't last long. And the end of the trend probably is around here. So the 23rd of October, when the next high could not beat the previous high. So we had a lower high, and we then had a lower low. In fact, we haven't seen a nice bounce to confirm the, well, not overly confirm, but to absolutely confirm that that is another lower low. So it looks like a downtrend in oil is happening right now. Bitcoin on a bit of tear the last few weeks. Uranium. Let's have a look at uranium. Uranium was interesting. Not uranium. Ethereum had a massive update. What happened here? It was up 12.3% on the 9th of November. And have a look. So people say technical analysis doesn't work. Where did it struggle to get above? The hold highs we saw back in April of this year. Almost perfectly. You see this a lot. The price of something will struggle to get up above previous highs, particularly if that far back. And the main reason behind that is you'll see some people who bought in at the high, they start to sell. That becomes resistance. And also traders know that area is going to be resistance, and they add supply to the market. So you got those old holders who want to sell out because Ethereum is a dog, not a Doge, but a dog cryptocurrency because the price fell after they bought in. And not only that, you have the traders, the short-term traders who know, particularly after a strong rise like 12 point whatever it was percent, that could be the top for Ethereum for the short to medium term, maybe even for the long term. Who knows? Copper. State of the economy or the world can be sort of related to copper. Copper looks bearish. It would look even more bearish if it falls below that line there, which is the lows we saw back in May and through October. I won't look at nickel, US oil. I thought I've already looked at US oil. Yes, I've already looked at US oil. What was I looking at before? Now, I didn't look at S&P. I'm pretty sure I looked at oil, didn't I? Silver, yeah, I won't look at silver. Oh, that's right. This is the wrong watch list. Okay, here we are. Back to lithium. Yeah, I forgot to change the watch list. So lithium keeps on going down. Down she goes. In fact, we've had 50 weeks of down. It's been going down since the start of 2023. Down from, well, this particular lithium. It's really hard to find lithium charts, I've found. So this is through TradingView, so I'm not sure how accurate this lithium chart is, but while the other charts I have seen, they are fairly similar to this. So lithium down she goes. And I talked about copper, coal, don't want to talk about coal, bonds. It's really interesting that there was a little bit of excitement among some, if you look at the daily chart, a little bit of excitement above some experts who saw a bit of a drop in the bond yields. Oh, they'll get excited. Oh, so bond yields, so the 30-year has fallen from 5.1% to about 4.76%. But look at the rise. So this is sort of like a little bit of a dip. It's not any reason to get excited about the stock market just because bond yields have dropped a little bit from the recent high. Just look at what's been happening. It doesn't go up in a straight line. Nothing goes up in a straight line. You always see these little dips, no matter what what chart you're looking at. Anyway, so I just ignore anyone who gets excited about this little dip in bond yields. And Australian 10-year, fairly similar to that. Anyway, so let's have a look at a few individual companies' charts. So we've got all these companies I do own, by the way. So we'll have a look at MRM, which is MMA Offshore, Step 1, Email Payments, Dicker Data, Bravura, Duratech, Atlas Pearls, and IPG. Looking at these for various reasons to peer into the mind of kneppyinvests. Okay, so MMA Offshore is a company I've owned and traded. I bought back in the breakout back in early 2022. when the share price was around about or just under 50 cents. So this is a beautiful breakout. So I suppose what we're doing now, what I'm going to show you now is pattern recognition, finding similar patterns. So this is MA Offshore. Back in 2020, extreme negative sentiment around this company. Share price fell all the way down to 24 cents in September of 2020, and the share price goes sideways. And then you started to see these little rallies that failed because there was resistance. And then what I wanted to see was the share price get above the high. So that's why I put a line here. And as soon as I saw the share price get above the high, particularly if it was on good, I can't remember why I bought it. If a breakout occurs on some positive financial news, that is a much more powerful breakout. And I'm pretty sure that's what happened to MRM or MMA Offshore, because this breakout occurred in February. And we all know February is reporting season. So they must have released some good results. And the share price moved into an uptrend. I took some profits back in May, between March, I forget exactly when the share price was going sideways. I thought I'd take some profits. But then they released something else, some other positive financial news on the 17th of July, and I've taken a trading position. Now, right now, it is looking the weakest for a while. The reason it's looking weakest, if we just follow this blue line, which is 150-day moving average, we can actually go back to 2022. Share price fell to the 150-day moving average and bounced off it twice. So at that point in time, there was less conviction about this company in the market. So it's not surprising to see it hit the 150-day moving average. But since then, or from then, you can see the share price was well above that moving average until recently. Share price dropped all the way down to this moving average ribbon, which is the long-term trend for the share price. And we have seen the share price rally again off the 150-day moving average. Maybe this is a good sign that the selling has come to an end and there are investors seeing some value in this company. So this is a trading stock, but I could also imagine some people buying this for the medium to longer term. Step one is again another breakout. A classic breakout, share price going sideways. Look at that share price going sideways for a long time, from May of 2022 through to August 2023. So we're talking about a 15-month consolidation period for the company. And what I did was put this line whenever the share price, the line at the top or the peaks in the share price, so the highs in the share price, and it correlated fairly well. Each time, which was 1, 2, 3, 4 times, we saw the share price get to that line, which was at 37.5 cents. The share price really struggled to get above it until the 22nd of August, again, reporting month. So again, I like when a company's share price breaks out of a consolidation period on good financial information. On that particular day, share price rose 5.3%. I believe that was a confirmed breakout, and the share price went on a massive run over the following or the next 3 or 4 weeks. A little bit of a dip in the share price. Share price moved into this shorter term moving average. And whenever the share price of this company moves into this shorter term moving average, 1, 2, 3, that's the time to buy. For some reason, the share price of this company rose 13.9% on Friday, the 10th of November, and is at 82 cents. Last time share price was this high was way back in May 2022. It's not that far back, but just look at the share price, what the share price did during 2000 or end of 2021 into 2022. So much negative sentiment in this company, and it does look like the negative sentiment in this company has changed to positive. There is positive sentiment in this company right now. Also, not only that, I've got a dividend, nice little dividend. And I consider the dividend for these type of companies just an added benefit. I would never buy step one for the dividend. Who knows, it could be cut next time. Email payments. Again, this is a classic. So pattern recognition, classic shift in sentiment. So I was listening to another podcast today, and in the podcast they said, well, technical analysis doesn't work because you can never pick the bottom or the top. The whole point of technical analysis is not picking the bottom or the top. No one can pick the bottom or the top. It's looking for changes in trends and sentiment. So if I were able to pick the bottom in email payments, I would have bought in November 2022 or March 2023. I didn't. But look what's happening with the share price. you can obviously see, without me explaining it, there has been a trend change and a sentiment change in this company. Share price is now up to $1.22, as high as $1.28 recently. And last time share price was this high was July of 2022. So we're talking about a 1-year high in the share price. And not only that, after this massive run up in the share price back in August, upon the release of their financial news, financial results, again, financial results are important. So maybe I'm a rare when it comes to technical analysis. I incorporate fundamental analysis and a news flow from companies when I use technical analysis. So we've seen 3 examples of that. And when this company released their financial results, it's surprised the market. It was a better than expected results. And after that, share price went sideways, and the share price is trying to go higher from now. Dicker Data, another company that I've took a position in, and this is another case of a change in trend and a change in sentiment upon the release of financial results in August. Look at that. Pretty obvious that the share price was in a downtrend. Not very long downtrend, but definitely in a downtrend. And then the company released their financial results towards the end of August. Share price rose 6% on one day, 11% the next day. And this was, in my opinion, a breakout in the share price. Not a classic breakout, but definitely a breakout. And the reason I say not a classic is because last time the share price was that high was less than, or about 6 months ago. So I am looking for 6 months high in the share price. But look what happened to the share price since then. And I bought in when the share price dipped back like this. Dipped back into this moving average, the short-term moving average. And you can see every single time the share price of Dicker Data moves into the short-term moving average channel, which is in green now, that's a buying opportunity. And you can see share price goes on little runs and then pulls back. All companies' share prices do that. Or Bravura is a company I'm hoping moves in this direction. We saw a couple of nice rallies in the share price. Again, 25th of August. Again, financial results. And another, well, I have to finish this video in 8 minutes. And another nice rise in share price on the 2nd of November. I forget exactly why the share price rose on that day. I think it was an update to their guidance, if I remember correctly. They gave some guidance for the financial year, and the market liked it. And the share price took off. Share price has pulled back, and on this pullback, I've taken a position in Bravura. It was at 80 cents, so it's down a little bit, but I don't care about that. I'm hoping this is a similar pattern to what we have seen with MML Offshore, Step One, email payments, and Dicker Data. So who knows, within maybe 3 or 4 months, maybe 6 months, the share price of Bravura will be $1.20. Now to Duratec, which is a company I bought on a breakout. I can't remember why I bought this one on a breakout. The share price broke out in November, maybe around the AGM, that sort of thing. But this is a classic case of the share price moving into an uptrend. Let's just zoom out a little bit more. So this company lists on the ASX, and straight away, negative sentiment in this company. Share price fell, and you can just see how the trend in this company shifted. After a long consolidation period, right here, we started to see the trend go up. And look at that beautiful trend. Now, that trend has come to an end, in my opinion. I have taken some profits, but I've maintained a position in this company simply because I do think there is potential that this company could grow from here over the next 5 to 10 years. So I wanted to maintain a position, but my initial reasons why I bought into this company have come to an end, and that was the breakout in the share price and a beautiful uptrend. Atlas Pearls. This was simply, I just looked at this company and went, well, there are risks in Atlas Pearls. They have had a really good year. And the chart I bought somewhere here, the chart started to look really nice, some really good volume coming in. And I bought about, I think it was 5.7 cents, share price now 9.3. Could have sold at 11 cents. But this is just another dip. So whenever you see these run-ups in share price, don't be surprised to see the share price just go sideways or even dip. It's very healthy to see that. So even the share price has fallen from 11 cents to 9.3 cents. It's very healthy. And the other thing you notice, and it's very important to look at volume, when the share price has been rising for this company, it's on really good volume. When the share price has been falling, it's on really low volume. So there's not a lot of sellers for Atlas Pearls right now. I thought this company was releasing Appendix 4Cs, but they're not, because this company is profitable. And not only profitable, it's not valued very high. It's only $40 million for a company that made $5 million in profit in 2023. And that's the second half of the year. It's only one half. This company made profit of $9 million in financial year 23, but has a market cap of 39 million. So P ratio of this company is 4.7 right now. That's why the share price is doing this. It's on fundamentals, and people are thinking maybe this company is cheap. Now on to the last company, IPG or IPD Group. This is another company I bought on sort of a combination of good financial news and the chart. A beautiful uptrend from when this company lists on the ASX. I waited a little bit to the first profit upgrade. Then I bought at about, I think it was $1.50 or something like that. Share price was in a beautiful uptrend. These little dips I weren't concerned about, but this dip I am concerned about. And my big question when it comes to IPD Group, should I take profits? I just don't know. But maybe I should take profits, maybe. And then not all profits, just maybe sell 70%. And then hold on to the remaining shares, because possibly this company could keep on growing just like Duratec over the next 5 to 10 years. So I'm not sure what I'm going to do with IPD Group just yet, because I am up big at this point in time. It's still over 100% gain since I bought in, more than 100% gain, but it is down a fair bit from its highs, $5 to $3.92. I'm not sure what's caused this negative sentiment in the company right now, but it's definitely there. The market is concerned about IPD Group. Who knows what those concerns are. Anyway, got 3 minutes. So that's all I have for this video, this technical and portfolio update. If you have any questions about any charts, any companies, my portfolios, just leave those questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.